The GameStop short squeeze. In January 2021, a struggling video game retailer, the kind of store you might walk past in the mall without a second thought, became the most talked about stock on the planet. GameStop share price went from around $20 to over $480 in a matter of days. Massive Wall Street hedge fund lost billions. And the people driving it were not big institutes. They were everyday retail traders organizing online. So first, what does it mean to short a stock? Before we get into the squeeze, you need to understand shorting. Normally, you buy a stock hoping it goes up. Shorting is the opposite. It's a bet that a stock will go down. Here, how it works in a plain term. You borrow a share of a stock you don't own. You immediately sell them at today's price. Later, you buy them back, hopefully at the lower price. You return the borrowed share and pocket the difference. If the stock goes up instead of down, your losses are not capped. A normal investment can only lose 100% of what you put in. A short position can lose far more than that because there is no ceiling on how high a stock can rise. Why GameSpot was a heavily shorted stock? By late 2020, GameStop was in real trouble. It was a physical retailer selling video game in the era when more people bought games digitally. Sales were declining and many big investors were confident that stock was heading towards zero. So confident, in fact, the hedge fund shorted an unusually large amount of GameStop stock. At one point, more shares have been shortened that were technically available to trade, a situation known as being shorted over 100%. This matter enormously because it means an enormous number of people were betting against GameStop all at once, setting the stage for what was about to happen if the stock moves the wrong way. Enter the squeeze. Here, where retailer trade comes in. Many of them organize on the subreddit Wall Street Bets. The thesis was simple. If GameSpot was shortened this heavily and enough people brought and held the stock, the price would rise. And here the key mechanic, when a heavily shortened stock rise, short sellers start losing money first. And at some point, many are forced to buy back shares to cut their losses to meet margin requirement. But buying back shares to cover a short push the price up even further, which then forces even more short sellers to buy back, pushing the price up more. This spiral is exactly what called the short squeeze. Rising price, forced short covering, more buying pressure, price rising further and repeat. It's a feedback loop, and once it starts, it can accelerate incredible fast. Things get extreme. Once the squeeze kick in, things escalate fast. GameStop stocks price rose from roughly 20 to over $480 within about 2 weeks. Some hedge fund that were heavily short GameStop suffered billion of dollars in losses. One major fund need a large emergency cash injection from other investors just to stay afloat. Trading volume exploded to level far beyond GameStop's normal activity. Retail brokerages, including Robinhood, restricted buying at GameStop and several other heavily shorted stock during the peak of the frenzy, citing collateral requirement from clearinghouse, a move that sparked massive public backlash and later congressional hearings. From a brief window, ordinary retailer traders coordinating online had genuinely moved a stock more than some of the largest funds on Wall Street. What happened after? Like most extreme spike, it didn't last. GameStop's price eventually fell back sharply from its peak, though it remained far more volatile and for a time far more valuable than before the squeeze began. The event has had lasting effect through it triggered US congressional hearing on trading platform, short selling and market structure. It brought mainstream attention to how retail investor could organize and move market collectively. It renewed debt over payment for order flow the way many free trading app like make money and whether it creates conflict of interest. GameStop itself used the attention and the stock price surge to raise new capital and attempt a broad business turnaround. Quick recap. So let's bring together. Shorting is betting a stock will fall with theoretically unlimited loss if it rises instead. GameStop was shortened extremely heavy by hedging fund. Retail traders coordinate to buy and hold, triggering a short squeeze. Forced short covering creates a feedback loop that sends the price up to over 20x. The followed reshaped conversion around retail trading, short selling, and market finance. The core lesson is when a huge number of people bid against something at all at once, that bid itself can become the vulnerability because there is no limit to how far a wrong shot can afford to run. If this made a GameStop sage finally make sense, let me know about your opinion in the comment section. We will come up with another case in the next video.